Have you ever sold options and watched as the underlying price kept inching closer and closer to your strike? I've been there, and it can be a really stressful experience, and a lot of people don't really know what to do when their short options get close to assignment. I mean, what do? Just run around the house in a state of panic while watching your loss get bigger and bigger? Or do you just curl up into a little ball and start to cry? Well, maybe, but you don't have to, because in this video, I'm going to be explaining to you what options assignments are, what they mean for the seller, and most importantly, how to mitigate losses if you're getting close to them. Now, if you're new to the channel, I publish videos about stocks and options trading, strategies to make money, and ways to reduce risk on your trades. So, if you like the video, I invite you to subscribe to the channel and click that notification bell to get updated when I publish new content. Selling options can be a great way to earn money, and some people even make a living with it. The thing is, to make money, you have to be right in your directional analysis of the market. So first, let's quickly cover what options are. Now, an option is a contract that gives the buyer the right, but not an obligation, to buy or sell stocks or an underlying security at a strike price on or before expiration. And buyers pay a premium for that, and they can exercise the option if they claim that right. Now, since we're talking assignment, I'll assume that you're the option seller or the writer, as they're most commonly known in options trading. So this means that if you're selling an option, you must fulfill the contract should the buyer exercise their right. And in exchange, you, the writer, get the premium up front. Now, if the buyer exercises their option, your short contract is now assigned. And a lot of traders get freaked out about when this happens, but there's really no reason for it. If you're selling an option, you just need to plan for it to happen. You have to plan for all of the scenarios. And there's really just two, actually. If the option expires worthless, or if you're assigned. Now, option sellers, they want the option to expire worthless or out of the money, because then they get to keep the premium and move on with another trade. Now, if you're assigned, this can be a little stressful, but it's not the end of the world. You just need to have a plan. Short options always carry the risk of assignment, no matter how small. However, you can still take some steps to minimize your losses in different scenarios. If you're assigned on an option contract, you'll either be buying or selling an underlying asset at the strike price. Now, with call options, that means that you're going to be selling stocks, 100 shares of stock or underlying per contract. And if you sold a covered call, for example, and collected a premium for it, and the stock rises above the strike, then you'll have to sell 100 shares of the underlying security at the strike price. Now, it's important to know that you may be liable for capital gains taxes in this scenario. So if you are, it might make sense to buy the option back closer to expiration if you don't actually want to sell your stocks. To buy your option back, you're going to issue what's called a buy to close order with your brokerage for an option with the same underlying, same strike, and the same expiration date. And once your order is filled, your short option or your short position will be zeroed out, and then you can move on to other trades. Now with put options, I can see that it might be a little scarier. If you're selling a cash secured put, or a naked put, as some folks call it, the risk is that you're going to have to buy stock and pay more than it's worth. So, say for example you sold a put on the SPY with a $400 strike price, and as you're getting closer to expiration, the SPY trades for 390. Well, if you're assigned, you'll be forced to pay $400 for a security that's only worth 390. If you're assigned on a put, don't panic. You're likely to have a paper loss in your account, and at that point, you can decide what to do next. If you feel that the markets are moving lower, well, you could sit tight and hold the stock and wait for it to go back up again. Maybe what you do is you might want to issue a limit, like a sell order with a limit on it. But remember, the stock could continue to move down, and you have to be comfortable with that. You can also sell covered calls on the stock and collect premiums as well to offset some losses. So when it comes to selling cash secured puts, it's really important to sell them on stocks that you'd actually want to own, because you might end up owning them at some point. Now, if you're using a multi-leg strategy like a bear call, bull put, iron condor, or any other, well, in this case, in my experience at least, I find that leaving them alone is often best, especially if the trade has a narrow spread width. But if you're at risk for a big loss, you could just adjust your short positions. Now, as I said before, it's rare for options to get assigned. Despite the chances being low, the chances are never zero, especially if the underlying security is moving against you and the option has intrinsic value. If that happens, and you still have time before expiration, you can mitigate or completely remove potential losses by adjusting your positions. And this means rolling the option by buying it back and then selling another one at a different strike price or expiration, or both. Now, you're going to want to pay close attention to your P&L, because adjusting your position within a multi-leg strategy will affect your profit. And by the way, I made an entire video about that topic, so be sure to check more about it up here if you want to know more about adjusting options trades. Statistically, only about 10% of options get exercised, meaning only 10% of short calls and puts get assigned. And that's because under most circumstances, the option holder or the buyer can make more money by closing their position, which means selling the same option to someone else to close out that trade. Now, to understand why that is, well, we're going to talk again about intrinsic and extrinsic option value. The intrinsic value is, well, what the option is actually worth. And the extrinsic value represents the amount of time that's left in the options trade, or on the contract. So some investors call it time value. Extrinsic value is what I call speculation. For example, let's take NVIDIA. Let's say today it's trading at $467.65. If you are holding a call option for that company with a $460 strike price that expires, let's say, in 13 days from now, then that call option would have $7.65 of intrinsic value. But if we look at NVIDIA call options with the $460 strike, we can see that they're trading for more than $16. And by the way, I got all this information from barchart.com, which is super helpful for all things stock related. So you can get the latest news headlines and essential trading information all in one convenient site. But going back to the topic, people are paying $16 for something that's worth $7.65. Why is that? Well, this is because options are time-bound contracts, and people are willing to pay more money for contracts that have more time before expiration, because they have more chances of being profitable. Wow, that's a lot of mores, but you get the point, right? So if you were holding a call option with a $460 strike and a 13-day expiration, and your choice was either to exercise the option for less than $8 of profit or sell the option for more than $16, well, what will you do? Well, the answer is probably pretty evident. However, the extrinsic value decreases to zero as the option approaches expiration. And that's why they're also called time value, because nobody's going to pay extra for a contract that doesn't have much time left to make a profit. And that loss in value is called theta decay, by the way. In any case, this is why assignments, when they do happen, often happen very near or at expiration. By the way, if you want to know more about extrinsic or intrinsic options value, I recorded an entire video for you about it right here. And if you already haven't done so, don't forget to hit the subscribe button to stay updated on the content that I publish regularly. Another thing that option writers need to be aware of is dividends, particularly dividend announcements and the ex-dividend dates. So dividend payments are paid out by companies to stockholders who hold shares before the ex-dividend date. So if an options buyer wants to get stocks, they might exercise a call option early. Similarly, put option buyers can exercise and sell stocks on or after the ex-dividend dates because they might want to avoid that usual price drop that sometimes happens after dividend or ex-dividend dates, and they've already assured that they're going to get their payout. But this would only happen if the option was in the money and it made sense to the buyer. Well, folks, that's what I've got for you today. Remember, the key to remember here is that there's no one-size-fits-all strategy when it comes to options assignments. Situations in the stock market may not always seem logical, but if your short call or put does get assigned, stay calm and move on to the next trade, and of course, consider all the scenarios. If you have any questions, don't hesitate to reach out. And if you haven't already done so, feel free to like this video and subscribe to the channel if you haven't already done so. Thanks so much for watching, and I'll see you in my next video. Bye.